Something did not add up. A few months ago, a viewer left a comment on this channel about a conversation she had with her bank teller. She had sold her car privately, a completely normal transaction, and received $8,500 in cash from the buyer. When she went to deposit it, she told the teller where the money came from. The teller entered some notes. The transaction completed. 2 days later, her account was flagged, and she received a letter asking her to come in and explain the source of the deposit. She had done nothing wrong. She had been a customer of that bank for 19 years. She was confused and, understandably, upset. I told her I would look into it. And what I found when I started reading the federal law behind what happened to her, law that has been running quietly inside every American bank since 1970, is what this video is about. I'm Anderson. I spent 5 years as a financial advisor in New York, working with families through retirement planning, Social Security strategy, and the kind of financial decisions that matter most in retirement. What I do have is the habit of following a question all the way to its source, reading the actual law, the actual regulation, the actual documented cases, and then explaining what I found in plain English. That is what we are doing today. Subscribe and hit the bell, because the rules around banking and financial monitoring change, and I will always bring you what the primary documents actually say. Now let me tell you what I found. The system I found starts with a law passed in 1970 called the Bank Secrecy Act. It was written to help the government detect drug trafficking and organized crime by requiring banks to report cash transactions above $10,000. The reporting form is called a Currency Transaction Report, FINRA Form 112. It goes to the Financial Crimes Enforcement Network, which is a bureau of the Treasury Department. The bank fills it out, you sign it, it is filed. That is the normal process. Here is the first thing I found that most people do not know. The report itself is not a problem. Filling it out does not put you on a watch list. It does not trigger an investigation. It is simply the record the law requires. The problem is not the report. The problem is what happens when the bank's monitoring system detects that you appear to be trying to avoid the report. And here is what I found when I read the specific statute. 31 U.S.C. Section 5324 BARTS that governs this. Congress created a separate crime called structuring. Structuring means deliberately breaking up transactions to stay below the $10,000 threshold in order to avoid the reporting requirement. And here is the finding that stopped me when I first read it. Structuring is a federal crime even when the underlying money is completely legal. You can be a retired teacher. You can have saved that money one paycheck at a time for 30 years. You can owe no debts, no back taxes, have nothing to hide from anyone on earth. And if you walk into the bank and say, in any words at all, that you want to keep the deposit under $10,000 so it does not get reported, you have just described a federal crime on the bank's recording system. The crime is the stated intent to avoid the threshold. The source of the money is irrelevant. When I kept digging, I found the cases, real people, documented by the Institute for Justice, a non-profit legal organization that has represented many of them without charge. Carol Hinders ran a small cash restaurant in Iowa for nearly 40 years. She deposited her cash revenue the way she always had, in amounts that reflected the natural rhythm of her business, typically just under $10,000, because that was what the restaurant took in during a normal cycle. The IRS determined that her deposit pattern fit the algorithmic profile of structuring. They did not charge her with a crime. They did not arrest her. Under civil asset forfeiture rules, which allow the government to take property suspected of involvement in a financial crime without first proving any crime occurred, the IRS seized $33,000 from her account. She spent over a year fighting to get it back. The Institute for Justice represented her. Eventually, after public attention and a policy change within the IRS itself, the money was returned. But the law that allowed the seizure did not change. An internal IRS policy changed in 2015, saying the agency would no longer pursue civil forfeiture in pure structuring cases where the underlying funds were legal. A policy, not a statute. A policy can be reversed by the next administration, the next budget cycle, the next directive from a political appointee. The law is still on the books, and the cases have continued. Linda McClellan, a convenience store owner in North Carolina, had over $17,000 seized under the same pattern. Andrew Clyde, a Georgia firearms dealer, had nearly $1 million seized. In every case, legal organizations had to intervene to recover what was rightfully theirs. These are not isolated incidents. They are the documented cases that made it to public attention. Most cases do not. The second thing I found involves the words that trigger a different kind of report. Not the currency transaction report for large cash transactions, but what is called a suspicious activity report, FINRA Form 111. Banks are required to file this report when they observe transaction patterns or statements that suggest possible financial crime, including elder financial exploitation, wire fraud, money laundering, or terrorism financing. The suspicious activity report threshold is not a dollar amount. It is a judgment call triggered by patterns and by specific words. When I reviewed the FINRA guidance on what triggers these reports, I found a specific category of language that flags accounts. Statements suggesting urgency or secrecy around a large transaction, references to overseas recipients in connection with unexpected wire requests, mentions of cryptocurrency in the context of moving money quickly, and, critically for the senior audience, any statement suggesting that a family member or third party is directing the account holder's transactions. That last trigger exists because of elder financial abuse, which is genuinely widespread and which banks are now legally required to help prevent. But it means that a senior who innocently mentions that their son told them to wire money, or that their daughter said to close the account, can trigger a compliance review even when the underlying transaction is completely legitimate. The bank teller is not making a judgment call. The teller is typing notes that go into a system. The system evaluates the language. The system files the report if the pattern matches. The third thing I found is the one that most directly affects seniors specifically, and it is the one that explains what happened to the viewer whose comments started this investigation. In 2018, Congress passed the Senior Safe Act. It gives bank employees legal protection from liability when they report suspected elder financial exploitation to authorities. Combined with FINRA Rule 2165, which allows financial institutions to delay transactions from senior accounts when they suspect exploitation is occurring, with holds that can last up to 15 business days under current rules. This creates a protection framework that is genuinely intended to help seniors, and it does help in cases of real exploitation. But it also means that certain things a senior says at the bank, things that sound completely innocent, can trigger a hold under the Senior Safe framework before any human being has verified whether the concern is legitimate. Saying that you need to move money quickly because you are in some kind of trouble, mentioning that someone unfamiliar is advising you on your finances, describing a transaction that sounds unusual even for perfectly legitimate reasons. Any of these can activate a review process that puts your account on hold while the bank investigates. The hold is intended as protection, but for the person who simply needs access to their own money, it can feel like anything but. So here is what I found across all three of these systems: the Currency Transaction Report, the Suspicious Activity Report, and the Senior Safe Act framework. And here is the practical protection that comes from understanding them. The bank is not your enemy. The bank is a regulated point of entry into federal monitoring systems that were designed in 1970 and updated incrementally since then. They were designed to catch criminals. They sometimes catch ordinary people instead. Not because those people did anything wrong, but because what they said matched a pattern the system was built to flag. The protection is simple, and it comes down to how you talk to your bank. If you are depositing more than $10,000 in cash, walk in calmly, hand over the deposit, and sign the currency transaction report when the teller presents it. The form is normal. The form is the law. Filling it out is what protects you. Never mention the $10,000 number in any context suggesting you were thinking about it. If you are making a large withdrawal, have a one-sentence reason ready before you walk in. Not an elaborate explanation, one plain sentence. It is for a home repair. It is for a private vehicle purchase. It is for a family gift. 6 to 12 words. True, boring, done. If you are wiring money to someone, the same principle applies. One sentence. The most ordinary reason you can accurately give. Avoid the words that appear in FinCEN's flagged language categories. Urgent, secret, overseas, crypto, online investment, in trouble. If a teller asks more questions than usual, answer briefly and calmly. The teller is following a compliance script. A short, clear answer moves things forward. Defensive silence or an argument moves things backward. And if you know in advance that a large transaction is coming, the sale of a property, an inheritance, a legal settlement, call your bank ahead of time and tell them it is coming, what it is for, and when to expect it. A transaction that is announced in advance, with a documented source, almost never gets flagged. It is the unexpected, unexplained pattern that triggers the system. Removing the surprise removes the trigger. Here is the single thing I want you to write down from this video. 3 nevers. Never time your deposits or withdrawals around the $10,000 number. Never size your transactions to avoid attention. And never argue with a teller who asks you a routine question. Those 3 nevers are your complete protection. Everything else I described today flows from them. The law already gives you the right to your own money. The only thing these systems can do is slow you down if you inadvertently say something that matches a pattern they were built to flag. Now you know the patterns. Now you know what not to say. And now you know why, not because someone told you to be careful, but because you have read the law behind it. If today's video was useful to you, share it with one person you care about who is over 60. The banking rules are real, the cases are documented, and almost nobody has explained them this clearly to the people most likely to be caught by them. Subscribe if you haven't, hit the bell, and I will see you in the next one.